Hey, San Francisco Bay Area. Today, we're here with a couple of super loan officers who are going to help us with some loan options here that are going to help our clients and you get into the home of your dreams. Today, we have our team, Aravet Makajian, Misha Morgray, and then Madison and Kashayla. They're going to introduce themselves, but you're going to love them. So I'll let you guys take it from here.
Okay, sounds good. So we are the Mad Cash team. I'm Madison.
And I'm Kashayla.
We are a mother-daughter lending duo. We're located in Solano County, but we service loans all over Northern California. So Bay Area, we have some transactions out there. So this is just our information, our email, our NMLS, our branch information. So today we're going to be talking about attractive strategies and programs for your buyers and sellers. We're going to be talking about today are going to be our down payment assistance programs, home equity lines of credit, seller credit, not price reduction, and seller credits for buy downs. So we're going to go ahead and get started. And if you guys have questions at any time, please just let me know.
You know, I'm really glad you're covering these things. These are actually they're all things that my buyers have asked me about recently. So I'm grateful. Thank you.
First off, we're going to talk about our down payment assistance program. So it's really important to know what clients are best suited for down payment assistance. What we're really looking for is going to be first-time home buyers. Even though some programs, they allow you to not be a first-time home buyer, a lot of them do require you to be a first-time home buyer. Also, clients who just have a lack of funds. So maybe they saved up for just the down payment and didn't realize that there are closing costs associated, or they have $20,000, but it just doesn't quite cover everything. So those are going to be some clients that we're really looking for.
So maybe that's a property driven thing. Maybe there's some deferred maintenance that needs to be done. So now they need to keep some of that money aside for doing some property fix ups. So there's a lot of different ways.
Yeah. And then also clients who just don't want to use all their savings. They saved up $30,000, $40,000, and that's enough for your down payment and your closing costs, but they're going to be broke. They don't have anything to come in with her to buy furniture, things like that. And then these programs are also really great for borrowers who make below the AMI for the county, so the area median income. And we're going to get more into that in just a bit. And also, go ahead.
Question. I see you have credit scores of 600 plus. What about people because I actually have someone in this situation who had a couple of collections. Is that a really bad, is that going to keep them from qualifying, or is that something we should always still send you those kind of clients to review?
Yeah, you can absolutely send us those kind of clients. Collections, if it's over 1% of the loan amount purchase price, we do have to add that into their debt to income ratio as a payment. But if it's less and they have the funds, we don't have to add in a payment. So it kind of just depends on their situation.
Oh, it's a collection history, a problem that they had in the past in this case. And it was only for like $1,100. It was crazy.
Yeah, we would just let sleeping dogs lay at that point. We wouldn't want to mess it up. If there was any reason that they would need to pay off that at the closing, that would be
done. They're already done. Yeah. Okay.
Yeah,
wow.
Yeah.
Okay.
Yeah, absolutely.
And we do also have what if simulators. So if there's ways that we can improve credit scores, we do have the ability to do that and give people a real clear plan on how they can improve them to be qualified.
Full service team.
Yep. Okay, so it's important to figure out as well is what do these programs offer these clients? So have a client who hits a couple of these items that are listed on there. Well, now what can they get from these programs? It's going to be anywhere between 3 to 7% down payment assistance to cover down payment and closing costs. So it kind of just depends on the programs. There are a million different down payment assistance programs out there, and it kind of just depends on what best fits them as an individual. Like on here, they offer low interest rates. So you're not seeing anything crazy high, but you're also not seeing anything crazy low. So it's kind of that good middle, but they're also receiving that down payment assistance. And then for some of these programs, they have deferred 30-year second and third mortgages. So essentially what that entails is when we're doing the purchase of the first, they can add on the second and third, and those deferred mortgages are only due at the end of the 30-year term of the first, or when you refinance or sell your home. And then there are also programs that have repayable 10-year programs. So they do have a payment associated with those. And those are the type of programs that we're seeing, 600 credit scores. The ones with the deferred 30 are going to be 640, 680 credit scores. So it definitely just depends on what best fits those borrowers. And then another amazing thing about these programs is when you can get even lower interest rates for borrowers who are making below the 80% area media income. So I listed right here, I pulled the counties and from your website of past transactions. So you can see that in San Francisco, Danville, Oakland, Novato, the area media income, 80% of the area media income is $120,880. And then you can see Campbell is $133,000. So if they're making less than that, they have the ability to have an even lower interest rate,
which is typically lower than just normal interest rates.
Wow.
They also get reduced MI.
And then so we worked up a mock sheet for one of the programs that we use, which is CalHFA. It's a pretty popular program in California. I'm sure you guys have heard about it at some point. So this one is going to be based on a $550 purchase price in Novato, so Marin County. This borrower would receive $20,170 in assistance. So that is going to be $16,500 for the down payment and $10,670 for the closing costs. This borrower is only required to come in with $4,330 at closing. So instead of coming in with, those bigger numbers, the 30, 40, whatever it may be, they're only coming in with $4,000. So it gives them a lot of room to work with. And then lastly, this program is the deferred second and third. So you do have the options for this specific county. Novato is the 80% AMI is $120,880. And the Marin County loan limit is $300,000.
Income.
What did I say?
Loans.
So,
Sorry.
so if someone is currently making less, do they have to have shown that their median income averages in the last couple of years, or is it current?
So it's current median income. So what we're going to do is we're going to take any average of any types of commissions, overtime, whatever kinds of incomes there is, and say we've got a married borrower, two borrowers, and they make over the $300,000 income limit together. Well, if we do the loan under just one person, then we're still qualifying them under that one person that's on the loan. It's not household income. So there's ways that we can get around those income limits as well.
So someone could really just buy this condo with $4,400.
Yes.
Mm-hmm.
And have a $3,700 a month payment.
And qualify for down payment assistance as long as they make under $300,000 in Marin County.
Under
And-
300 grand or under 133?
Under $300,000 in Marin, and then if they would qualify for a lower interest rate if they made less than $128.80.
Okay, so 300,000 is a median income? I don't know. I'm sorry, I'm confused.
So that's the income limit to use these programs.
That's their posted income guidelines for this particular loan program.
Yeah. So for instance, if you are in Marin County and you make $280,000 a year, you can still qualify for a down payment assistance program. Let's see here. I wanted to.
Does it have to be primary residence?
Yes, for some of these programs, it does have to be primary residence.
Still, when you're looking at this, it's like, okay, so it's just over a 1 month rent to get the property. And then after that, you're paying what the rents are out there.
Yeah,
and you own
absolutely.
a house. You own a place. That does not include the HOA, though, sounds like.
No, it does not include the HOA. So with this program, it can be for a single family residence. It can be for a condo, conventional. And then if they needed to go with an FHA program, we would just have to do an FHA approved condo.
Right. At that price point, that's more of a condo, if they're lucky to find a condo at that.
In 1 bedroom.
Yes. Hold on 1 second. I'm going to share some other screens with you.
So here are the actual HFA rates. So when we were talking about the 80% AMI and the Marin County income limit, the income limit to qualify for a CalHFA loan with the deferred second and third, the standard rate if we were doing the CalHFA conventional 3% is right here. Less than 128.80 and still qualify debt to income ratio wise, then they would qualify for the 7.625 versus the posted 8.125.
Can you make this bigger, please?
Yeah, absolutely. Can you see this?
Yes, that much better. Thank you.
Okay. Yeah, so these are going to be the low income rate locks. So this is what they're offering, 2%, 3%. So you can see that it's definitely a lot better than these standard, but these standards are pretty good considering what interest rates are looking like right now. It's pretty much in line with what we're seeing. Perfect. So do you guys have any questions about the down payment assistance program?
Yeah, I do. Do they have to take classes, I understand, or online classes, some specific class?
Yes. So there is one class that they have to take. It is a home buyer education course. It is an 8-hour course and it costs $99. And that's a requirement for a lot of these programs is for them to take this class. Some other down payment assistance programs, if you have over a certain credit score, you are not required to take it. The one that we showed you is CalHAFA. They require it regardless of your credit score. But I know for, I believe it's GSFA is another down payment assistance program. If you have over a 720 credit score, you do not have to take the program.
And that could be online through eHome America or any in-person HUD approved program. I actually teach the city of Vacaville's first time home buyer program for HUD, which services all the Bay Area and is an in-person class held at the library. So we have those availabilities too.
Perfect. Any other questions about this one?
No, I just, I didn't even know this existed. So I'm really happy. Thank you.
Awesome. Makes me happy to hear. Okay, so the next thing that we're going to be talking about is home equity lines of credit for down payment. So the best clients for these types of programs is going to be clients who want to follow the county loan limits. So are you guys familiar with loan limits?
I'm not sure what you mean.
We're trying to avoid any kind of jumbo financing or jumbo financing underwriting. So if we don't have reserves, we don't have score, we don't have self-employment people that may not qualify for a typical jumbo loan product, but we could couple it like an 80-20-20 is what you would hear back in the day, like a 80% second. So we're staying within conforming loan limits, and then maybe a 10% second, and then 10% down.
Wow. So you girls are really being as creative as you need to be to help somebody get into a home.
Yeah, absolutely.
You do more than I've seen any loan officer do.
Well, and we also do renovation loans and those kinds of things. But I think with our loan limits, it might get a little hairy in your area. So we were just trying to kind of pull out just what we thought might work and then build on there from that.
Great. Thank you.
Yeah. So borrowers who want to follow the county limits, that's a really good one. We're going to get more into that. Don't want to be contingent on the sale of their home for the equity. So if they need to use that equity of their home to purchase a new property and they don't want to be contingent, you can use a home equity line of credit to get around that. This program is going to be really great for borrowers who have low debt to income ratios and credit scores of 680 plus. So the first way a home equity line of credit can be beneficial for a client is if, say, for instance, a borrower has the funds for an 11% down payment on an $885 purchase price and the closing costs, but they don't want to use a jumbo loan product due to the stricter underwriting guidelines. So say, for instance, they are a self-employed borrower and, they just know that they're not going to be able to qualify for those jumbo products because of their self-employment income documentation. So the way that we work around this is the borrower has the ability to use the value of the home that they're purchasing to do a concurrent home equity line of credit, or a piggyback is what they call it, to use the equity in the home that they're purchasing for the down payment, which gives the borrower the ability to follow the county loan limits and use a conventional conforming loan product.
And then
what's the timeline on that?
It's the same. So basically, what this also can help circumvent is mortgage insurance when you're not using a jumbo loan and you're putting less than 20% down, because your first mortgage is going to be 80% or less. So you don't have that mortgage insurance.
Wow.
Yeah. So I included the conforming loan limits for the FHA. So if you took a look at one of these websites, you could see, like right here, this is what this website looks like. So you went right here All of these gray spaces is the conforming loan limits for most of the United States. So you're going to see this loan limit of 726,200. So that is the loan limit that we follow in almost every circumstance. Anything above that, even if it's these higher cost areas, we want to follow the 726,200 because that is our conforming loan products. So anything above this, and say for instance, Alameda County is 1.089 mil. So anything between 726,200 and 1.089 is going to be a high balance, and anything above 1.089 is going to be a jumbo product. So you can kind of get around this by making sure your loan amount is 726,200.
And the home equity lines of credit, we can do lines up to like 500,000. So if we needed to do that first mortgage on a way lower loan to value and do a second mortgage on a higher, we can get creative with that.
Sounds like basically you're going to be paying a higher rate for the HELOC, but you're going to get a lower rate for your mortgage, your first loan. And that still nets to be a better situation than the higher rate. Is that what you're saying?
And you don't have mortgage insurance because you're putting less than 20%.
And okay, go.
Less than 20%.
And okay, got it.
Yeah, and then go ahead.
I was like question asking about, so this is if the person wants to keep the primary residence, the HELOC that she's taking money off, and buy second property. Yes, is that the situation?
Well, there's two ways.
Yeah.
So they can either take a home equity line of credit on their current home and buy the future home and use that as down payment, or they can buy a new home going forward, put 10% down, and then not have mortgage insurance, and qualify for both homes. So there's multiple.
Will the second home be still a primary residence, or is becoming investment property, and then interest will be higher?
Well, so if they didn't want to be contingent on the sale and they wanted to sell that home, but they didn't want to deal with having to sell that and buy it at the same time, and they qualified for both, then that's basically just going to give them time to pay that mortgage off before they even have to make a payment on it, because they're going to sell that home and list it for sale.
Right. And if you're getting a HELOC, does the HELOC ask the question if it's primary? It doesn't, right? It's just a HELOC. It's a second loan on a primary residence.
Well, typically we would be originating those home equity lines of credit to be pulling cash out prior to us originating the purchase going forward. That would be more strategic plan. So yes, we would originate that as a primary residence, but they do have that ability to do those for second homes if they were planning on, moving out of the area and keeping that as a second home.
Still, I think at the end of the day, our clients, if we send them to you, you're going to figure out what's going to be the best fit, and they're going to have a couple of options from which to choose.
Yeah, absolutely.
That could be a good scenario for Sabina. Yeah.
Yes. Yeah, we have yes. Great. Yeah. I mean, right. We're already thinking about people we'd like to make sure talk with you.
So you guys do HELOCs?
Yes. And closed-end seconds. So we have fixed rate seconds and home equity lines of credit.
Okay.
And it's not taking, like a while ago, loan officers were saying, oh my God, I can't get them done in less than 90 days, But
Well,
you guys
that was honestly because of the amount of business everybody had. Nobody's really doing a whole lot. So our appraisers aren't backed up. Our underwriters aren't backed up. So that's really what allows us to be able to push those forward a lot faster.
Super. Okay.
Yeah. So this is kind of what it would look. This is a mock scenario for this right here. So $885 purchase price. This is going to be their first mortgage. So we're going to be putting that they're doing 20% down, 6.625% interest rate. This is what their first mortgage principal and interest payment would look like, taxes and insurance. So their loan amount is going to be $708, down payment $177,000. So even though that borrower can only come in with, $11,000 and some change for the closing costs, we have the option to do the second. So they're below that county loan limit, and they're also more than 20% down, or almost exactly 20% down. So they don't have that mortgage insurance either. So this is what that second would look like. So $885 purchase price, first mortgage balance of $726,200, initial advance of $61,450. So it would be first mortgage principal and interest, $4,533. This would be the home equity line of credit payment homeowners insurance and real estate taxes, and this would be their total payment for the purchase of that $885 purchase price home.
Total payment right there?
Yes,
Is that, but that does not include property taxes and insurance, right?
it does.
It does.
Yes.
So and how much money out of pocket?
$11,000 total out of pocket would be.
Gosh, my nephew wants to buy 16 acres with a house in Fresno at that exact price. And I'm going to send him to you after this phone call.
Awesome. That's so exciting.
Yeah.
So total out of pocket would be $135,000. But obviously we can play with those numbers. This is just a mock. It's,
Basically
very
10%
quick.
down plus closing costs. So when you're doing a home equity line of credit, we typically call it an 80-10-10. So you'd have 80% first mortgage, 10% second, 10% down.
$135,000. That would be your monthly payment. That's for both property. That's including the HELOC and everything.
Yes.
Okay.
Taxes and insurance.
That's includes both properties? I'm sorry, I can't.
So this is the one for just the one property. So if you're
Yeah.
purchasing a new home going
Mhm.
forward, it's going to be your only primary residence. You're not going to have a second home or an
Then-
investment property.
And what is 110,000? Is it the down payment 10%?
Yes, 10% plus the closing costs.
Yes. So the second way is what we were talking about earlier, is if they don't want to be contingent, but they want to use the equity from their current primary residence or, current investment property, you can change up regardless of how you want to go about it. But the borrower, say, for instance, the borrower wants to put in a property, put in an offer on a home and doesn't want to be contingent on the sale of their current home to use the available equity for the down payment and closing costs. This borrower has the ability to take out the standalone home equity line of credit on their current property to purchase the new property. So once the purchase is funded and recorded, the borrower can sell the initial home and pay off the home equity line of credit before they've even made a payment on that HELOC. It gives them the option to not be contingent, but it's a concurrent transaction. So we are closing the home equity line of credit 2 days before we close their new purchase. And so those funds just get transferred to the next escrow account.
It seems a little complicated, but I feel like our clients will be in good hands with you managing
We do them all the time.
the confusion. Right.
Yes. I mean, it's the same idea if you were doing a cash out refinance on your current property. It's same type of thing. You can close them concurrently. It's a little bit of extra work, but it's not anything we haven't done before.
How much time they have to sell the first house?
Whatever time that they wanted. If they didn't want to make their payments, their first payment, probably as quickly as possible, so they don't make that first payment. Or if they were fine with making that payment for a couple of months and then putting their house on the market, it's completely up to them.
Or even if they truly wanted to just convert that home into a second home and take a home equity line of credit out and they qualify for both properties and all the payments and all the combined loan to value and all that stuff, then we're just good to go. It's just their qualifications.
Okay, thank you.
Now I know why my client in San Rafael worked with you and got creative, because he totally doesn't want to take money out of his pocket and he wants to buy the best property he can. And great.
Yes. This is just one of the programs that we work with for the home equity line of credit. This is called Symmetry. This is what we would be looking at that first example. So primary residence, maximum CLTV of 89.99%, minimum credit score of 680, and maximum debt to income ratio of 45%. This is that second option that we were just talking about. So the standalone home equity line of credit, minimum credit score of 700, 45% debt to income ratio. But as you can see, we can take up to $500,000 in equity out of a home, and the max combined loan amount is going to be $3 million. So we do have a lot of room to work with.
And then another thing that I would just point out, if you have people that are a little bit cash poor or wanting to do some things and needing to pull out some money, we can do those home equity lines of credit. And then they have a 10-year draw period on that. So that means they can use like a credit card, pay it off and charge it paid off and charge it as many times as they want to utilize those funds or replenish those funds and maybe do like a cash purchase with like a delayed financing for afterwards. And then they also have an interest only option for the first 10 years where they only have to pay interest only payments. So that is another option.
Can I ask a question? Is this HELOC program, is it stable? Because I did want to qualify one of my clients with a lender, and then in 2 weeks he says, oh, we don't do this product anymore. Is this kind of, you guys been doing it? Is it steady?
Yeah. So back in 2008, because I've been in this industry for far too long, in the downturn of the market, you were seeing a lot of home equity lines of credit being frozen because of, you know, the reduction in values and whatnot. Mm-hmm. And then you see companies ebb and flow in and out of the market. So like we're a banker and a broker, so we kind of have the whole gamut of things. Mm-hmm. So we've got in-house seconds and home equity lines of credit, and then we also have broker type of things. So if a particular company goes out of business or pulls out of the market, then some lenders will lose their opportunity to do that. But we have multiple avenues to go down. So I don't see that happening unless there's a huge reduction in values.
I see.
Yeah, and Symmetry has been around for a good amount of time. So I don't really see them going anywhere anytime soon.
Okay.
Any other questions about these home equity line of credit products? So the next thing that we're going to be talking about is for your buyers and sellers. So this one I was kind of thinking on the seller side, but it also could benefit your buyers. You're going to have leverage on both sides as a listing agent and as a buying agent. So seller credits for buy downs, not price reduction. So in this instance, do you have a listing that you're not really getting any offers on and you want it to be more enticing to buyers? So the reason why we would use a seller credit is because in today's current market, we're seeing clients being priced out of homes that they were once approved for because of interest rates, or we're seeing a lot of people drop out of contracts because interest rates are just too high and they didn't realize that, oh, that's going to be my payment now. So instead of doing a price reduction for, $10,000, for instance, the seller can offer a seller credit of $10,000. So it would be the same purchase price, but hey, I'm going to give you this $10,000 seller credit to buy down your interest rate. And that can benefit the borrower by reducing their interest rate by 1% or more.
Are you saying that there are situations where even if the price were reduced by $10,000, the borrower would not qualify, but they would qualify because the 1% allows them to have to make smaller monthly payments?
Exactly.
Okay.
Yeah. So the way that you can leverage this on both sides is as a listing agent, you can say, I don't feel like reducing this purchase price by 10 grand. I'm going to put on here $10,000 seller credit for a buy down. And
is it a formula 10,000 is equals to 1% of the rate reduction?
Yeah, pretty much that's what we're seeing right now.
Okay.
Yeah. That's kind of what we're seeing. I just priced out for Anna today a $450 purchase price, and originally the interest rate would be 7.375, and with $10,000 price reduction or seller credit, their interest rate would be 6.07.
That's really good.
Yeah, so it's absolutely
so the
fantastic.
difference in the payment is really where they're going to see it. Because as lenders, we don't sell rate because we don't have control over rate, right? You don't have control over market and pricing out homes and stuff. The consumer is pushing that. We're only, able to sell what we've got. So to us, we're selling us being able to get them to where their payment needs to be and reverse engineering that, and then having an exit strategy in future for our plans A, B, and C.
Okay. Thank you.
This is so great, right? Because, by the way, these buyers I spoke with you about, who I have not connected you with, did go to another lender that their realtor suggested and came back with, sorry, there's just no way. And I just don't believe it. So I'm going to be connecting you, and let's see. I mean, that'll be fun, because if that works out, I want to do another video and we'll find out why you were able to get them alone and nobody else was.
Yeah, absolutely. And I sent you the numbers this morning. So take a look at
super, thanks.
Yes.
Great.
So, and then the way that you can leverage this option as a buyer is, say, for instance, you and your buyer are looking at homes and you see a home that they really, really like, and they just reduce the price by $10,000, $15,000, $20,000. You can put in an offer for that original amount that they had listed and say, instead of doing the price reduction, let's do that as a seller credit. And then that can go towards buy down of the interest rate. It can go towards your closing costs. And so the buyers are like, hey, it's going to be the same amount that I'm going to get either way. But if this is going to be able to get this buyer in this home, that's going to work for me.
Sounds good.
Yeah. And then we also do have a buy down option. Those are great for borrowers who have no problem qualifying, but they are rate sensitive. They're seeing these interest rates and they're like, oh, I don't know if I make this payment for the next 2 years or until we can refinance, something along those lines. So this option gives the borrowers to temporarily buy down the interest rate for 3 to 1 years. So right here is I have a 3-2-1 buy down and a 2-1 buy down. This is based off of a $625 purchase price, 10% down. Just like I said with the seller credit, if you see those price reductions and the it is amounting into something like this, like they reduce the price by $10,000, $15,000, $20,000, you can say, hey, if you do this buy down, this would be your first year. You're reducing on this 3-2-1 by 3%. So for the first year, their interest rate would be 3.825, and their payment, principal and interest, would be $2,629. And then for the second year, we're going to reduce it by 2%. So 4.825%, and their principal and interest would be $2,959. By the third year, they're at 5.825%, which is $3,309. And then by the fourth year, they're back to this initial rate of 6.825. And within that time, we could have seen fluctuation in rates. They could have gone the 4%, and they're like, all right, I'm good. Time to refinance. And I'm good with the 4% rate. And now I don't have to worry about this anymore.
And then in addition, if that rate does go down, and that $25,000 credit that we got from the seller to do the 3-2-1 buy down, if say in 1 year rates go down to 4% and they refinance in that first or second year, we're using whatever is not being utilized by that buy down that was covered from the seller that's essentially subsidizing those payments over those next 3 years as a principal reduction on their loan balance, so they don't lose out on that money.
So on the previous scenario that you presented, is that $10,000 buying down the rate for the entire loan?
Yes.
Or just, okay, so that's the difference between the two. I see.
Yes. So this is a permanent buy down for just this initial seller credit.
Right.
And this is a temporary buy down.
And so we have a 3-2-1 buy down, as you'll see right there. And then we have a 2-1 buy down. So like the 3-2-1 buy down is going to cost about $25,000 in this scenario. A 2-1 buy down, where you're only on the rate down for 2 years, is only going to be about $13,000 in this scenario. We also have a 1-1 buy down. But again, once we get into the thick of the battle with clients and they're in contract and we see what rates are doing, then at that point we kind of juggle and figure out our best.
Wow.
So it's about 2% reduction, yes?
Yeah. So if you see, this is 6.825. The payment would be $3,600. It would be $2,600. So their payment would be $1,000 less than what it would be at current market rate. The second year, it's $700 less than what it would be at current market rate, and then $300. So they're really getting that savings because it's being subsidized by that $25,000 seller credit.
Yeah, it's clear that you've been teaching this stuff for a while, because I really feel like you have a way, you understand how to communicate this to people. Every loan officer does. So I really appreciate setting this up and explaining it to us. Thank you.
Yeah, absolutely. So last thing is just a general question and answer. If you guys have any questions, any other type of loan products you've heard about, or you have, a question about something random that you heard about, go ahead and ask.
We're not afraid of doing loans or getting our feet dirty.
Yeah, no, I know. Remember, our first introduction together was with somebody who I never thought was ever going to be able to get a loan, and you saved the day with him. So, and he's still in his house today, I think almost 10 years later. So it's wonderful.
I may introduce you girls to a buyer seller that I have that either wants to do a HELOC or maybe just buy down rate something because she wants to buy a bigger home,
Okay.
Okay.
and we'll see.
And I think that I don't know if you already sent it to the members of the team, but I also know that you have some marketing material that could be helpful with some of our listings, so that we can push out there that you have different loan options to help buyers who may want to try to qualify to purchase one of our properties.
Yeah, so I sent invitations via list reports to all of you, and then I did send up like a little mock advertisement type of thing on just a property, so you could go in there and see there's like property dedicated websites, QR codes, Facebook posts, printables, sign writers, all kinds of cool stuff. And that will automatically populate when you have a listing. And then if you guys have open houses that you're doing, or you want me to create a marketing kit for anything that you might be hosting for somebody else, just let me know and I can create that, and it'll automatically email to you and you can push it out.
And sounds like you would not be opposed to all showing up if we did a first-time home buyer or any kind of home buyer program, whether it's kind of a Zoom kind of thing. You wouldn't mind showing up and being there to answer questions and helping people through the process also. It's what you do.
It would be our pleasure.
Everything.
Yeah.
Okay. I'm really happy. This is really great and so helpful. I'm done. How about you guys? How about Adavik, Misha?
Yeah, just one more quick question. As far as like so we talked about like first time buyers and low down payment programs, but you guys do the whole spectrum of like, if someone's like wanting to buy a fixer, and you mentioned a renovation program.
Yep.
If we're working with developers or investors, you guys can help with those as well.
Yep.
Self-employed.
Yes, and we do commercial financing as well. So we do have really the gamut. If there's something that you're interested in, just let us know and we'll dig deeper into it and make sure that it's something that's viable for your client.
Perfect. I do have a commercial listing right now, so I'll get in the nitty gritty with you.
Oh, and that commercial listing could really use your help. So, yep. So excited that we had this afternoon to talk with you about this.
Yeah, absolutely. Yeah. We're the type of team where if there's something we don't know, we're going to learn about it and we're going to do it for you. So anything under the sun, we got you.
And you know what? That's a good match for us because that's who we are. Yeah. Right. We just go out and we're kind of fearless and fierce about supporting our clients and caring about them and helping them through this process and helping them find the right match, whether it's a loan or a house or whatever. So I thank you. Thank you so much.
And we are licensed. I'm licensed in California. She's licensed in California and Idaho. And then if there's any other states, just let us know because we can get licensed pretty easily. I used to be licensed in many, many states, but make sure it's feasible to keep the licensing.
And in our situation, I was talking to you about a client in Florida, right? Yeah. And so you guys are doing the upfront work and then going to just do whatever you can to make sure that they get the right loan.
Right. Yeah. So if you have anybody moving anywhere in the country, we can originate it. We can pre-approve. We can price it out. We can get them all set up. And then once they figure out, because a lot of people just don't even know where they're going to land, right? You know, they're just waiting for a job offer or whatever. And then once they've gotten to where they're going to go, then we can transfer it off. We still get a commission, like a referral, like you would normally get. And then we make sure that they get handed off to somebody that's going to deliver the same level of service that we would.
I do have another client who doesn't have the last 3 years of taxes filed yet. What about that situation?
So we do have some portfolio products, bank statement loans and stuff like that. And it's just going to have to be person specific to figure out really what
interest rates are probably a little higher for something like that, but not impossible.
But it's better than what I would say seller financing would be because you still get it rated on your mortgage and all of that.
Got it. Okay.
Or your credit rather.
Thank you. I'm done.
Thank you, ladies.
Yep. Super.
Thank you for having us.
Yeah, it was great.
Feel free to email me with any questions. If you click on those list reports, things that we can get your profile set up so you can get running on that as well.
Hey, listen, we're done with this interview, this whole call. But if anybody out there really appreciates what they just heard, we'd love it if you commented, emailed us, let us know what you found valuable, because that's how that we need to hear it, and we'll bring more, knowing what is important to you. So that's it. I'm saying goodbye. Thank you, everyone.
Thank you.
Goodbye. Thank you so much.
Thank
Yeah.
you. Bye-bye.
All right, that was it. Let us know what you thought about that, and I hope you got some value out of that last interview. This is Anna Spathis with Sterling Homes. All of us here at Sterling Homes want to help enrich your life through real estate. All you have to do is ask, what are your questions? What are your fears? What are your successes? And how can we help? That's why we are here. We've been doing this since 2004, and we're going to keep on doing it and helping people, and we're going to enrich their lives through real estate. Hope we can do that for you too. Bye.